Hello from Trend Signal for a review of the data and events week beginning the 17th of December, the final week before Christmas. The Christmas New Year period tends to be quite subdued for the celebrations. Monday morning, Far East markets generally firmer overnight, but cautious ahead of some key events this week. So European bourses sort of treading water to slightly weaker actually. Dollar flat to slightly lower, whilst gold and crude are all unchanged, so nothing too much to report straight off. The data this week is dominated by central bank meetings, and probably the most important one being the FOMC, the Federal Reserve's rate setting committee, the final meeting of the year, and a lot of expectation around that meeting. Markets last week, stock markets generally down in the US, certainly down. S&P suffered quite a lot on Friday, pushing the indices down on the week. 350 down on the Dow, S&P down 34, so that's both around sort of 1.3, 1.4% lower. Conversely, FTSE actually put in a not a bad performance, bearing in mind all the Brexit angst last week and the vote of no confidence. 173 points higher on the FTSE, was about 2.5%. The DAX not quite as strong, but 90 pips higher on the week, which is a very modest return, and the Nikkei lower in line with the Dow and S&P 300 odd points lower. It was really the poor Chinese data that soured the market on Friday, but tech stocks again undermined the market, with the likes of Amazon down 4%, Apple down 3%, which is quite a considerable move really for the two of the largest capitalized companies on the market, and well, globally as well, really. UK markets, well, just in another world, really, with almost every move determined by Brexit. Last week clarified absolutely nothing and just brought us another week nearer to the 29th of March. The Brexiteers did lose one option, though, by being forced into a no-confidence vote on May, which removes that option for another year. But May's task, I should say, looks pretty hopeless, as we seem to be heading for either a no deal or a second referendum. Both not a particularly appealing thought, really. Let's have a look at the data and events this week through Forex Factory. Big week, as I said, for the markets. We've also, on top of the FOMC, we've got our own MPC, the Monetary Policy Committee, the Rate Setting Committee of the Bank of England, and all the associated data, plus the Bank of Japan. Let's just start. Monday and Tuesday, it doesn't look like we've got anything, but there are one slightly lower level report from the German IFO Business Climate Survey. A slightly weaker number forecast in Germany. Germany really has suffered, with 30% of their exports going to the Far East. The US-China trade war has really taken its toll on some of Germany's key exporters, hence the reason why the DAX has been under the water for most of the year. Tuesday, also something that has attracted more attention now, which is the Central Economic Work Conference in China, and the reason being that following the poor data last week out of China, we had retail sales hitting the lowest growth in 15 years, or the slowest rate, I should say, in 15 years, and factory output as well. That was the lowest in 2 or 3 years, I think 3 years. So it's possible the state could announce further monetary stimulus on top of the monetary stimulus that they've already announced to help bolster the flagging economy. But things don't look particularly inspiring there. Okay, let's kick off now with Wednesday. We've got our own CPI data, that's a Consumer Price Index for the UK. Another small dip in prices, perhaps as the price of fuel eventually succumbs to the fall in crude oil, about time. 2.3 versus 2.4 last. And really the main event of the week, and the day and the week, is the Federal Open Market Committee. The final meeting this year. We expect the Federal Reserve to increase rates again for the fourth time. That may not be the defining moment from the Fed, though, as the market is very keen to know about the outlook for next year. It's what rates are going to do next year. We're pretty certain, or the market is certain, that the rates are going to go up on Wednesday, but it's what the Fed is saying about the prospects for next year. Recent analysis of forward rates suggests traders are betting that the Fed will raise rates at most by 1 notch and then stop. So the gradual rate rise program, if you could call it that the Fed have been managing over the last 2.5 years, that'll be it. So to two and a quarter to 2.5% is where we expect interest rates to end up at the end of this year. And I guess the Fed are going to weigh up the expectations of the market. They expect a rate rise. State of the stock market, not looking good. Solid economic data, it has looked good. And Trump's criticism of Jay Powell. My own feeling is that Trump's criticism would be enough to see rates go up again. There's nothing like a meddling president to encourage Mr. Powell to just stay independent, is the advice that everyone is screaming at him, I suspect. The problem is next year, with 50% of investors in the US expecting a recession in the next 12 to 15 months, which is that's quite a high call rate, really. I think the benefits of this tax break early this year will fade once we expect the US-China trade war to impact prices and growth, especially if we don't see a resolution in the near term. So really the key bit will be the statement, and really the market will be hanging on every word from Jay Powell as to what the Fed is thinking about next year. And that will have a direct impact on stocks, on bonds, and of course the dollar. A lot of analysts are suggesting that if there is a recession, of course, that won't be good for the dollar, which has looked all right over the last 3 months, of course. Thursday, we have the Bank of Japan policy meeting. Obviously, no change in rates. I say obviously, but they never change rates. Seems the bank is probably more likely to warn on growth concerns, so the chances of a rate rise are just receding every week that passes, really, and they'll focus on the U.S. protectionist policies that Trump has pursued and the effect it's having on global growth. Not good for the bank, not good for rates anyway, especially if you're looking to get more for your savings. Retail sales in the UK, some pretty dire data. Recent data suggests sales have fallen off the edge of the cliff. Brexit, got to throw Brexit in, of course. Bad weather, the internet, all rolled out as excuses. But I think this number could be probably worse than that. And I note on Monday morning, an announced profit warning from ASOS, which is quite a darling of the retail sector, which has really hit the sector generally. But also ASOS losing 37% of its value as it report gave a profits warning on Monday morning. Not looking good. No, not looking good as we run up to Christmas. So where are we? Okay, MPC. Yes, that's a very good point. We have our Monetary Policy Committee here in the UK. Well, absolutely no change. I say absolutely. In the run-up to leaving the EU on the 29th, the bank can't afford to do anything. Really, they can't afford to say anything either. The bank's hands are tied. I suppose, in fact, so are the hands of the consumers in a way, and that's what we're seeing in the retail sales. And the politicians, in that matter, have got their hands tied unless something happens in Parliament. What a pickle, I'd describe it as. A pig's ear or a pickle, one of the two. And also, for what they're worth, we could have some forecasts that sees a downgrade to UK growth prospects, but really it's sort of irrelevant because it really depends on what happens with the Brexit deal. It could just, everything could turn around on a sixpence. Friday, durable goods in the US, and then the final of 3 readings from the final GDP reading. That's the final of 3, I meant to say. Expect an unchanged number at 3.5%. A backward-looking number, so it's not really that important. Certainly the third reading isn't, but contrast 3.5% with UK and European growth. Quite a difference. That's it. Thank you very much for listening. Bye for now.